been quite a while since my last video, and the reason is because there hasn't been really much to talk about in the markets. The markets have been rebounding, pretty smoothly despite the ongoing threats by President Trump that he's going to impose tariffs on Europe and tariffs on steel and China and stuff like that. Because the market has more or less figured out that to make money in today's markets, you have to follow what we call the taco effect that everyone is talking about on social media. So what's the taco effect? It is basically Trump always chickens out, where at first he'll come out with some crazy statement that it's going to be 100% tariffs on China, 50% tariffs on Europe, and then people freak out, they sell the stock, and then a few days later he says, well, I changed my mind, let's lower the tariffs, and then the market bounces back. And so you could have made a lot of money just on this taco effect. And so far the market has gotten immune to these threats because of taco. But what's next in the markets? Let's take a look at the charts to discern the current price action. So from the peak in early February this year, you can see the market went through over a 21% drop, but it fell short of a bear market because, as you know, a bear market, like I mentioned before, is one where the price has to close 20% above the high, which it did not. In fact, it went 21% below the high, but by that day itself, intraday, it closed 17% below the high. So officially, it's not a bear market, it's just a very big correction. So a lot of people panic sold right at the bottom, and of course, Jim Cramer at the time said that we're gonna have another Black Monday, and he always calls the bottom with his bearishness, right? And in fact, a lot of hedge funds, they went short the market, they were net short. I'll show you the charts later on, it's pretty interesting. And then, of course, that was the first taco effect when then Trump said, okay, we're going to pause the tariffs for 90 days, and the market went woo, right? And the market went all the way up. And then he came out and said, okay, I'm going to impose 100% tariffs on China. And then China said, we're going to do the same thing. He said 120%, 150%. So they started escalating their threats. And again, the market went down again. And then he tacoed again and said, well, I'm a nice guy. I don't destroy China. I'm going to lower the tariffs. And the market went up. And then we broke above that trend line resistance. So once we broke above this trend line, that was the first possible indication that the downtrend had broken. But as you guys remember in my last few videos, I said that's not enough. We need to see the price close back above the 50% Fibonacci retracement and then close above the 61.8% Fibonacci retracement to really show that the downtrend has been broken. And sure enough, the market did that, and then the market gapped up above the 200-day moving average, went all the way up here, and right at the top, those bastard and Moody's, what did they do? They issued their credit downgrade. And in the past, when Fitch and S&P downgraded the US debt, the US markets dropped 20%, but then rebounded very fast. So the market said, hey, we've seen this movie before, we're not going to get fooled one more time. So this time when Moody's downgraded the US debt, yeah, it went down slightly, but then boom, it went up again. So you can see that over time, the market gets immune to all these things. The market gets smarter and says, you know what, I've seen this movie before. When the market panics, it drops, it rebounds back very quickly. So a lot of retail investors, in fact, I'm very proud of retail investors because, in the old days, people always say that the retail investors get suckered by the smart money, the institutional investors. But increasingly, I have found that in the last few years, the last 5 years, it's the retail investors who are getting smarter and smarter because they're getting more and more educated. And it's the institutional investors, the hedge funds and the mutual fund managers who are the ones that have been really getting it wrong. And again, I'll show you some statistics later on, but in fact, it was shown that during this plunge, it was the retail investors, people like me and you, we were buying, and the institutional hedge funds, the so-called smart money, they were selling everything, keeping in cash, in fact, shorting the market, and now they're getting effed by the market. They're getting screwed by the market, and a lot of them are still net short. They're suffering huge losses, or they're in cash, so now they are forced to chase the market higher. Now, so as far as price action is concerned, you can see that we're clearly back on a uptrend again. You can see the 20 EMA, which is this red line, above the 40 EMA. So whenever the red line, the 20 above the 40, that means the short-term trend is up. You can see here the 20 was below the 40, so this was a downtrend. This was obviously an uptrend initially. And then here, the 20 crossed back above the 40, so this is a signal where the short-term trend is officially up. And then you can see that the price is back above the 200-day moving average, which is this thick red line. And whenever the market is above the 200-day and the 200-day slopes up, that is a very, very powerful medium-term trend in the market. So we are very, very bullish, right? Of course, I always say that no one can predict exactly what's going to happen in the markets. No one can predict short-term price movement with 100% certainty because there are too many unknown variables. We can't predict Trump's next tweet. We can't predict what Putin's going to do after Ukraine attacks Russia. We can't predict all that stuff. All we can do is to look at the current price action, make educated guesses based on probability. So the fact that we are on an uptrend means that the probabilities that prices would likely go higher, right? Everything else remaining equal. So as of now, the S&P has made up all the losses for the year. It is slightly positive. So I still think that we've got a good chance to end the year with a double-digit return in the S&P 500. As always, it paid to ignore the news headlines. It paid to ignore the noise, which I've been preaching about for so many years, right? The more you read the news, the more misinformed you get, the more stupid decisions that you make. And you can see clearly that when the market dropped all the way to the bottom of the correction, right at the bottom, we had CNBC host Jim Cramer warning that Black Monday market crash over Trump tariffs was going to be worse than 1987, right? So when you know that someone on TV gets really, really negative, that usually marks the bottom. And then the day after the bottom, you have got on the, the 7th of April, right? From Mike Wilson, Morgan Stanley, he said investors should brace for another 7 to 8% drop in the S&P 500. Okay, and then a few days later, you can see on the 11th of April, we've got Bank of America right here saying that short the S&P 500, short it, probably because they were short themselves. Okay, and they wanted the market to go down. If it went up, they'll lose a lot of money. But sorry, and then what happened next? And then you had over here on the 9th of May, we had stocks are at risk of a drop of nearly 20%, says Goldman Sachs. And then bear market is coming soon with S&P 500 rally stalling soon, D-Mark says. So it's a very famous technical analyst. Then on this day, we've got Paul Tudor Jones, another professional trader, saying that stock market will hit new lows even if Trump cuts China tariffs by 50%. The negativity, why? I don't know, they're just all like that, right? And then most recently, we've got Robert Kiyosaki saying that we're gonna die in June, in summer, we're gonna die. He's been saying that shit for the last 20 years, right? Okay, so it's very entertaining to read all this negative stuff of people. Of course, on that day, we've got Moody's cutting the debt, and the market says, push it, and proceeds to go up. At this point of time, the market seems to not be that affected by the tariff threats anymore by Trump because they realize that it's just a negotiation tactic that, in the end, he's going to work things out, right? But how about other things? So, of course, there are some people who are worried about treasury yields, that bond prices keep going down, and when bond prices go down, the treasury yield keeps going up, and won't that threaten the stock market if treasury yields are too high? Well, let's put things in perspective. First and foremost, you can see that treasury yields are lower than where they were at the start of the year. All right, at the start of the year, treasury yields were at 4.8%. And right now, they are at 4.41%. So it's actually lower since we start of the year, right? And it is where it is 1 year ago. And the current treasury yield at 4.41%, if you ask me, is it too high? I don't think it's too high. I think it's a very normal yield. Now, remember that before the great financial crisis, the 10-year treasury yield was between 4 to 5%. So that is normal. But in the great financial crisis, the Federal Reserve, they embarked on quantitative easing. They cut interest rates to zero in 08-09, and they did the same thing in 2020. So that caused the 10-year yield to drop to, again, 2-3%. So that was not normal. In other words, the last 15-18 years, the 10-year yield was not normal because of quantitative easing, right? Now it is normal. It's at a normal level. And historically, if you take a look at this table that's from Fundstrat, which I found pretty interesting, you can see that the PE ratio on the y-axis is the PE ratio of the S&P 500, And on the x-axis, the horizontal axis, this is the US Treasury yield. And you can see that historically, since 1930, the PE ratio of the S&P 500 has been the highest at about 20 times earnings, thereabout, when the 10-year yield was between 3.5 to 5.5%. So in other words, we are currently at 4.6% or 4.5%, which is right here. We are right at the sweet spot. So unless yields go way above 5%, there's nothing wrong, right? The market, I think, is pretty normal at this stage. So be careful of that narrative. Then, of course, some people say, but wasn't a recession coming? I was promised a recession, and that's why a lot of people sold out in May, because they thought these tariffs would bring the US economy crashing down into a recession. Just like they predicted that high interest rates will crash the US economy in 2023, it didn't happen. Remember, the US economy is stronger than you think. So just 1 month ago, the media was playing up the recession narrative. Almost every headline said recession is coming. Think ahead, how to spot a recession. America is dangerously close to the worst kind of recession. The Dow Jones tanks over 200 points as US economy shrinks, recession fears loom. Critical Economic Wednesday to show how close the US is to recession. So why all this recession talk 1 month ago? Because the US Q1 GDP came in negative. And that freaked everyone out, right? So the initial reports was Q1 GDP was negative 0.3%. Now, what happened? Just a few days ago, they revised that and said it was not as bad as we thought, right? So the new revised Q1 GDP growth from minus 0.3% initially, now they reported it is minus 0.2%. So not as bad as expected for Q1. And how about Q2, which has not yet been reported? It's coming up soon, right? So if we look at the Atlanta Fed GDP now, real GDP growth estimate forecast, as of now, Q2 GDP is tracking at 3.8%. And if I'm not wrong, I think they just raised it again to over 4%, I think yesterday, if I'm not wrong. So in other words, based on this, recession avoided, right? In fact, there was none to begin with, not close, but the media again likes to create this doom and gloom and fear. One reason is because a lot of the media is very left-leaning, and of course they want to make Trump look bad, so they like to play up all the negative stuff. Okay, then how about inflation? The other thing you may worry about is inflation. Tariffs create inflation. Yeah, maybe, and maybe it's coming later. I don't know, right? But for now, it's not appearing in the reports as what people are predicting. You can see that the PCE inflation index, which is the Fed's preferred inflation gauge, 2 days ago came in softer than expected. So inflation came in at 2.1% year-on-year increase, below expectation, or rather softer than what people feared, and only increased 0.1% in April over March. And you can see very nicely, inflation continues to head downwards towards the Fed's 2% target. So I think that we still have a good chance of getting at least 1 to 2 Fed rate cuts by the end of the year, right? So recession not an issue, inflation so far not an issue. Tariffs, markets seem to be taking it in its stride. Plus, for the rest of the year, remember, the Trump administration has 3 approaches: tariffs, tax cuts, and deregulation. So tariffs, the media was playing up the negativity, right? So that's kind of like the worst is over, okay? But tax cuts and deregulation is coming, and that is very bullish for stocks for the second half of the year. These next few charts are pretty interesting. And as I said earlier on, I'm very proud of retail investors because in the past they were the suckers, but now they're not the suckers. Now the institutional investors, the hedge funds, they are the suckers. Okay? Because what happened? When Trump, Liberation Day, when he announced all these tariffs and the market dropped, and everyone got very, very pessimistic, we're going into a recession, we're going to die. And a lot of these hedge funds, what they did was that they went short the market. So they bet on the market going down even more. And many of them, they went overweight cash. So they sold their stock, they kept cash. And what happened? The market rebounded so fast that they literally all got fucked, right? So for example, you can see in this table here that macro hedge funds have had the worst start to a year on record. Okay, one of the worst starts to the year. So year to date, you can see macro hedge funds as a whole, they are down 5% this year because instead of staying invested, they sold all their stock, they shorted the market, and they got really, really screwed. And not just macro hedge funds, you can see that among other fund managers survey, FMS fund manager survey, US equity allocations are the lowest since May 2023. So in other words, a lot of them, they sold out and they held cash, and hedge funds have added 25 billion of short equity futures exposure over the last 3 commitment of trader reports, the largest increase in at least 10 years. So you can see how short hedge funds have been in April and May. And again, when the market rebounded strongly, they got really screwed in the ass. The fact that these big institutional investors are underweight stocks, overweight cash, and short the market, is that bullish or bearish? That is very bullish for the markets. Why? Because now that the markets keep going up, what happened to these hedge funds? They are forced to cover their short positions. That means they are forced to go and buy stock in order to cover their short positions. And by buying the stock, that adds fuel to the rally even more. And many of them now look very stupid because they are overweight cash, they don't have enough stock, and they are going to look like they're going to underperform for the rest of the year. So now they are forced to chase the market. They are forced to deploy their stocks. And so all this dry powder coming to the markets is then fueling the rally. Of course, are they happy? They're not happy. So these institutional investors, they will do their best to talk the market down, to give the media all the negative reasons why the market will crash, hoping that the market will go down so they can get in at a better price, right? So that's why this bull market has been really hated a lot by the institutions. But then again, remember, every new bull market after a bear market or after a correction is always hated because it happens, the market goes up as the majority are in disbelief of it going up. If you can still remember back in 2020, during the COVID crash, remember what happened? A lot of people were saying that it's going to get worse, it's going to take years to recover. And then the market went up so fast, people were in disbelief. How can it be? The economy is dying, people are losing their jobs, the market goes up. It doesn't make sense. Yes, it does. Okay. If you had watched my video with my Coke bottle, I explain why the market is not the economy. The market, the economy can be in the crapper, but the market can still go up because the market is not the economy. The market is a leading indicator of the economy in the next 6 to 9 months. And you can see as the market went up here, what happened? Same thing. You get all these negative news. Goldman Sachs warns S&P 500 might not bottom until hitting 2,000 points, which was much, much lower, right? IMF chief says pandemic will unleash the worst recession since the Great Depression. And then of course we have got our dear friend Jim Cramer, where during the early rally over here, he said, I'm convinced there will be more selling, right? And of course, the market kept going up because, the stock market is designed to fool most of the people most of the time. When everyone thinks the market is going to go down, it tends to go up. When everyone thinks it's going to go up, it tends to go down. It tends to go the opposite of everyone else, okay? Because when the majority are bearish, they are underweight stocks and overweight cash, and this cash by the sidelines provides the dry powder to fuel the rally as reality turns out to be not as bad as everyone expects. Same thing that happened in 2023. So after the 2022 bear market, again, people said 2023 we're going to have a global recession, it's inevitable, according to the economists. Stocks are poised to hit new lows this year, survey of investors shows. The stock market will fall 25% when the looming US recession hits in 2023, says Deutsche Bank. But what happened? Again, the market went up against everyone's beliefs, right? And then same thing is happening right now. After the market went down, you've got again all these negative predictions, negative news, we're gonna die, it's gonna get worse. And what happens? The market, the bull always climbs a wall of worry. And that's why ignore the news, focus only on buying fundamentally great companies that actually make money. They've got positive free cash flow, or simply buy the index ETF, stay invested, and add shares whenever there's panic. Be greedy when everyone is fearful. But again, be greedy on great companies, not lousy companies. You buy lousy companies that drop, they never come back. You got to buy great companies that you know are great, and they drop only because of short-term cyclical reasons or short-term bad news that over time they will overcome. I don't know about you, but I do hope that you also took advantage of that market correction in February to add shares to great companies. So personally, I added, right? I bought more Nvidia, I bought more Amazon, I bought more Meta, I bought more Google. I added a new position in Copart, which is an online auction company. And of course, I bought more Novo Nordisk, and of course, I added more UnitedHealth, which I just recently added back. So year to date, my portfolio is up 5.34%. Which is okay given the fact that a lot of the sectors I'm in have been underperforming, and that's versus the S&P 500 that's only up 0.92%. And for the last 12 months, the portfolio is up 16.75% versus the S&P 500, which is up 8.71%. So since there have been a lot of questions about my UnitedHealth, whether I'm adding more and why I'm confident to add more, maybe I'll just spend the next 3 minutes to talk a bit about UnitedHealth. So again, UnitedHealth, they're going through a lot of short-term problems, and so the stock is down quite a bit for the year. If you take a look at the chart of UnitedHealth, let's take a look at it right here. And let me just go to weekly charts. So you can see that it's down about 60% from the highs. So the first question you got to ask yourself again is that, are these short-term problems, or is this a long-term structural problem with the economic mode of the business? And in my opinion, most of their issues are short-term issues, one of which is higher than expected medical utilization costs, which they can easily overcome once they raise their premiums, because they do have that pricing power. Then of course, they've got other things which are more narrative driven, like their CEO got killed and they're accused of fraud, of which there's no evidence. In fact, a lot of these accusations, when they go to court, they found that there's no evidence. And a lot of it is, to me, I think it's just a hit job on the company by some assholes out there, right? Okay? So I'm not too concerned about that. But having said that, when I do my valuation, I like to always put in the worst case scenario. So what if their margins compress? What if their Medicaid business really gets affected? By the way, Medicaid only makes up about, if I'm not wrong, less than 15% of their business. That's the one where they're accused of fraud. So even if they have to pay a lot in fines, for example, that they are found guilty, and their business reduces as a result of that, then we factor it into our valuation, okay? So the great thing is, for those of you who have subscribed to Stock Oracle, you can see the valuations right here. So if I put in UnitedHealth, you can see that before all this, the intrinsic value is about $560, okay? So what we did was we lowered the valuation, assuming that the worst happens, assuming they get fined, that they are guilty, they pay the fine, lowers the Medicaid business. So in the worst case, we are looking at the shares being worth $460, worst case, right? But again, if it turns out that there's no fine and there's no evidence, then of course it's worth $550, $600, okay? So I like to buy when the price is a lot lower than the valuation, even accounting for all the bad news, right? So we call it buying with a margin of safety. So you can see at the $304, you've got a pretty good margin of safety here. All right, selling it at just a PE ratio of 12.74, which is historically pretty low, right? So you can see that it's a very predictable business in terms of cash flow, revenue, very profitable, but growth has taken a hit in the short term because analysts have lowered their growth projections because of again, these issues. That's why this was lowered. But again, once that is resolved, I expect that to go up again, right? And of course, the mode of the business, I've lowered it slightly from a wide mode to a narrow mode business because of some of these additional regulations that may limit their pricing power. But they still have pricing power because of their monopolistic nature in the managed healthcare market. Financial strength, they're very strong, balance sheet very strong, and of course, valuation very high because it is very, very undervalued right now. The other thing that also gives gives me a bit of confidence in the fact that I don't think the fraud stuff is a big deal. It's the fact that the management themselves have been buying stock a lot. Okay, so remember, when the management sells stock of their own company, like in Palantir or Google or Amazon, they've been selling their own stock, I don't bother. Remember, an insider sells stock for all kinds of reasons. They want to buy a new yacht, they want to finance their rocket ship, right? So no big deal where the insider sells, okay? But when an insider buys their own stock, you pay attention, because they only buy for one reason, because they know that it's worth more. Okay, so insiders have been buying. The new CEO of UnitedHealth has spent 25 million of his own money buying his own shares. So that is not bad. That's pretty good, right? In addition, if you track the trades of the government themselves, the members of Congress, you can see that they have a lot of inside information, and it's a lot of legal corruption, right? And you can see over here that the members of Congress, they recently, in the last 3 months, they have been net buyers of UnitedHealth stock. And those bastards were selling before the fraud news came out. So they have a lot of this insider information, right? And specifically, you can see these were the Congress people in the last 3 months, whether they are Republicans or Democrats, both of them, they have been accumulating a lot of UnitedHealth stock. So that gives more confidence that, these are all short-term issues, right? Okay, so yeah, so that's all I have for this video. I hope you enjoyed it, and of course, if there's more happenings in the market, then I'll have the chance to make a lot more videos. So till then, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.